Good morning, good afternoon, and good evening to those of you who are joining us online. Thank you all very much for taking the time to join our discussion today, our dialogue today, around strategies for reducing private sector costs in Africa. How do we unlock economic growth through the private sector, but in particular by reducing the cost of private sector engagement? My name is Hannah Ryder. I'm the CEO of Development Reimagined, and we're really pleased to be partnering with the Center for Strategic and International Studies based here in DC for this event, and really pleased to have all of you join us here in person and also online. The aim of today, we're going to have a number of different sections of the discussion. We will begin with some opening remarks, a keynote speech from Dr. Yemi Kale from Afreximbank, the Chief Economist and Managing Director at Afreximbank, a very important partner of ours. And we will then also have a presentation from my colleague Trevor Luere, which will also outline some of the some areas around private sector engagement that we've done some analysis on, and we hope to do even more next year. Then we will move into a panel discussion where we will have both online and in-person participants, and we'll have a dynamic discussion and hopefully also some time for some Q&A with those of you, our audience, here in person and also online. And then we will have closing remarks from Vemba Dizolele, our partner here at CSIS, the Director and Senior Fellow of the Africa Program. So we have a packed morning of discussion, but just to frame a little bit about why this discussion, why are we talking about the costs of private sector engagement? Because quite often in development, we are usually thinking about the private sector, especially in terms of development finance, usually thinking about the private sector as a route to almost uncostly impact, uncostly development. But what many governments have learned and do interact with private sector is, of course, private sector is very important, especially the international private sector and the domestic private sector. But nothing comes without cost. I'm an economist, so there is no free lunch, as we like to say. But what are the costs? How do we leverage the private sector without creating too many costs? And those costs can range from risk premiums. They can also range from certain types of concessions that we have to agree with, especially when it comes to certain projects with private sector actors. And they can also range into also other types of challenges that we might face with managing the private sector in terms of even things like ESG and those sorts of standards. So it's a fairly wide-ranging discussion, but nevertheless, we think this is also a very good time to have this kind of discussion. The reason being, of course, there have been more and more discussions around what is the Africa risk premium and the perceptions about the risk premium in African countries. But also, this is a point in time in which we're shifting from the Brazilian, we're about to have the G20 presidency, the Brazil presidency, hand over to the South African presidency of the G20. And as you know, the African Union is now a member of the G20, or what we like to call the G21. And that also creates an opportunity for African countries and governments through the AU and other partners to be able to effectively advocate for shifts and changes that are necessary in the international financial system. So that's why we're having this discussion, and we hope that it will be timely for that purpose, and also in terms of your own work in development and general economic growth. So with that, setting the stage, let me now pass on to Dr. Yemi Kale from Afreximbank, Chief Economist and Managing Director, as I mentioned, to give his keynote speech and to also set the stage further for our discussion today. Thank you.
Distinguished guests, ladies and gentlemen, good morning. I think I should add good afternoon and good evening as well. It's a great privilege to address you today on behalf of Professor Benedict Orama, President and Chairman of the Board of the African Export-Import Bank, to discuss what I believe is one of the most urgent challenges facing Africa: reducing the costs faced by the private sector, thereby unlocking the immense potential for economic growth and structural transformation across the continent. I would like to begin by extending my profound gratitude to Development Reimagined and the Center for Strategic and International Studies for hosting this very timely event during the World Bank IMF annual meetings, and for inviting the Afreximbank Group to deliver this keynote address. Distinguished guests, ladies and gentlemen, Africa's potential, with its youthful population, its vast natural resources, and its promise of deeper economic integration through the African Continental Free Trade Area, is well recognized. Yet, this potential remains constrained by significant challenges, notably the high costs of capital, exacerbated by what we call the African risk premium. Now, this premium, combined with biased debt sustainability assessments and distorted credit ratings, imposes undue financial burdens on both African governments and the private sector. The question we face today is therefore, how can we systematically dismantle these barriers, reduce private sector costs, and enable sustainable growth and transform African economies? Credit rating agencies have a role to play in this process. They have long served as gatekeepers of global capital. They wield immense power in determining how much African countries and businesses must pay to access much-needed financing. However, there is a growing recognition that the methodologies used by credit rating agencies are not only flawed, but also perpetuate an unfair narrative about African economies. Despite the significant progress made by many African countries, such as improving macroeconomic fundamentals, increasing transparency, and undertaking structural reforms, credit rating agencies often assign ratings that do not reflect these improvements. For instance, it is well documented that African countries consistently pay higher spreads on their bonds compared to countries with similar or even worse economic conditions outside the continent. This disparity stems from outdated methodologies that do not adequately account for Africa's unique economic environment. CRAs, credit rating agencies, often overemphasize short-term risks, such as political volatility or fiscal deficits, while downplaying long-term potential and resilience. Moreover, the diversity and growing dynamism of African economies are often overlooked, resulting in inflated risk assessments that push up the cost of capital. At Afreximbank, we have been at the forefront of advocating for reforms to the global credit rating architecture. We believe there are two essential pathways to reform. Firstly, African governments and businesses must engage in coordinated, sustained, informed dialogue with credit rating agencies. This requires providing more transparent and accurate data that reflects the continent's realities, ensuring that rating agencies must make assessments based on a fuller understanding of local conditions. Secondly, we need to develop homegrown solutions by supporting the establishment and strengthening of African-led credit rating agencies. African credit rating agencies must be strengthened to provide more accurate assessments that reflect the realities of African economies without being overly influenced by the perceptions of external actors. These agencies can play a key role in balancing the global narrative and ensuring fairer financing terms for African nations. Distinguished guests, ladies and gentlemen, the African risk premium, which refers to the persistently high interest rates that African countries and businesses face when accessing international financial markets, is driven by perception rather than reality. It is rooted in historical biases.
Recording in progress.
And a failure by global markets to properly assess the improving fundamentals across many African countries. Let us consider the scale of this challenge. Now, at the height of the COVID-19 pandemic, when African economies demonstrated remarkable resilience, they were disproportionately penalized. Over 56% of African countries saw their credit ratings downgraded, even though the continent's average economic contraction was far less severe than in other regions, such as in Europe or Asia. For instance, available data shows that Western Europe, the Middle East, and North America were among the hardest hit, with their GDP contracting by 6.5%, 3.1%, and 3% respectively in 2020, while Africa's GDP contracted by just about 1.4%. Despite demonstrating greater resilience, Africa was subjected to higher borrowing costs, pushing the continent further into debt distress and limiting its capacity for meaningful economic recovery. This distortion must be corrected if Africa is to realize its full economic potential. The consequences of the African risk premium extend far beyond higher borrowing costs. They undermine investor confidence, they stifle private sector growth, and entrench perceptions that Africa is an inherently risky place to do business. Now, to overcome this, it is important that we build robust data ecosystems. We need to counter this negative perception with hard data by working to develop platforms that offer real-time, comprehensive data on African markets, providing investors with a clearer, more accurate picture of economic conditions. This will help to dispel outdated notions of risks and encourage greater capital inflows. We also need to deploy de-risking mechanisms by developing a range of financial instruments, such as guarantees and blended finance models that are designed to mitigate the risk perceived by international investors. These tools are crucial for reducing the African risk premium and attracting much-needed investments into sectors like infrastructure, energy, and technology. Distinguished guests, ladies and gentlemen, debt sustainability assessments, which are the frameworks used by international financial institutions to evaluate a country's ability to manage its debt load, however, often fail to account for the transformative potential of strategic investments in infrastructure, in healthcare, and in education. These investments, while potentially increasing short-term debt, are crucial for long-term growth and economic resilience. Unfortunately, African countries are frequently penalized for making such investments, as the rigid nature of current DSA models overlooks the long-term benefits of development finance. This has created a cycle where African governments are discouraged from borrowing for productive purposes, further constraining growth. We must therefore advocate for the adoption of a more balanced, forward-looking DSA. Such assessments would acknowledge the critical role that investments in human capital and infrastructure play in encouraging long-term economic stability. By making the case for these forward-looking assessments, African countries can help ensure that international financial institutions adopt more equitable approaches. Additionally, African governments must continue to improve their public finance management systems, including through enhanced transparency, efficiency, and fiscal discipline, which are critical for improving debt management and building confidence among international investors. At Afreximbank, we remain committed to providing the technical assistance and capacity building support that is needed to strengthen these systems across the continent. While addressing the systemic issues of credit ratings and debt assessments is vital, there are several practical strategies that can reduce the cost of doing business in Africa and directly benefit the private sector. This includes improving infrastructure and reducing logistic costs. One of the greatest challenges African businesses face is high logistic costs resulting from poor infrastructure. Whether it is inadequate roads, inadequate ports, rail, or energy infrastructure, these deficits significantly increase the costs of moving goods and conducting business. According to the African Development Bank, logistic costs in Africa are 2 to 3 times higher than those in developed economies. So to address these challenges, Africa countries should consider public-private partnerships and investing in digital infrastructure. PPPs are powerful financing models that blend public resources with private sector capital, therefore sharing risks, reducing costs, and ensuring efficiency in project implementation. African governments can leverage private sector expertise, innovation, and financial resources to fund infrastructure, energy, and industrial projects that are vital for long-term economic growth. Governments and the private sector can therefore work together to build efficient transportation networks, including expanding ports and rail lines, and modernizing and rehabilitating energy grids, enabling businesses to reap economies of scale. Digital platforms, internet connectivity, and e-logistics solutions are also crucial in reducing transaction costs and improving supply chain efficiency. As the AfCFTA gains momentum, digital solutions will streamline customs and border processes, reducing delays and costs. Enhancing access to affordable finance is also a critical factor to reduce private sector costs and stimulate economic growth. The availability of affordable credit remains a critical challenge for African businesses, particularly small and medium enterprises. High interest rates and other stringent credit conditions, including restrictive collateral requirements, making financial inaccessible for many. We at Afreximbank have long recognized that unlocking private capital is key to bridging Africa's development financing gap. We also understand that the conventional sources of finance, such as foreign aid and commercial loans, and even foreign capital, are no longer sufficient or sustainable or are too expensive for all the reasons I've mentioned earlier. As a result, alternative financing structures must be developed to crowd in private sector investments. One good model to mitigate these challenges is blended finance, which uses concessionary capital from public and donor sources to mobilize private investments. By blending concessionary loans with private capital, Africa can reduce the risk profile of critical projects and reduce the cost of capital. The concessional capital serves as a buffer, attracting private investors who might otherwise be deterred by these perceived risks. Additionally, scaling up trade finance instruments such as factoring, leasing, and credit guarantees can bridge the liquidity gap for SMEs. The African diaspora is also an untapped resource in terms of both financial and human capital. So by creating attractive diaspora bonds and remittance-linked financial products and other financial instruments that speak to their specific requirements, Africa's private sector can mobilize capital from the diaspora. Remittances to Africa, for example, exceed estimated $50 billion annually, and tapping into this pool through structured financial products will reduce reliance on expensive foreign capital. We also need to strengthen our local capital markets, which are still quite shallow. Developing local bond markets and promoting equity financing will provide businesses with alternative, lower-cost sources of capital, thereby reducing the reliance on high-cost foreign borrowing and helping businesses manage their financial costs. Moreover, we need to also reduce regulatory burdens and enhance African business environments. Bureaucratic red tape, inefficient regulatory frameworks, and complex licensing procedures significantly add to the cost of doing business in Africa. Accordingly, governments must prioritize simplifying administrative processes, reducing the number of licenses needed to start a business, and eliminating redundant and cumbersome procedures. Streamlining tax policies and ensuring consistency in their application would also reduce uncertainty and compliance costs for businesses. Furthermore, creating one-stop service centers where businesses can access licenses, permits, and regulatory services in a single location, whether physically or digitally, can help reduce time and costs of setting up and running businesses. We need to also promote regional integration through the AFCFTA, which presents an unprecedented opportunity to reduce trade barriers and harmonize regulations across Africa. However, to fully leverage this opportunity, we must focus on cost reduction in cross-border trade. To do this, we need to reduce tariffs and eliminate non-tariff barriers that inflate the cost of cross-border trade. This will make African goods more competitive and allow businesses to scale beyond their national markets, thereby reducing unit costs. Streamlining customs procedures and adopting digital technologies for trade facilitation, such as Afreximbank's Pan-African Payment and Settlement System, will also reduce the cost of delays and inefficiencies at borders. This will encourage businesses to take advantage of Africa's growing intracontinental trade opportunities. African countries to lower energy costs. As you may be aware, Africa's energy costs remain among the highest in the world. Limited access to reliable and affordable electricity increases operational costs for businesses, particularly in manufacturing and other energy-intensive industries. To close the energy gap, we should invest in renewable energy and expand renewable energy projects such as solar, wind, and hydroelectric power, which can help reduce energy costs while also promoting environmental sustainability. Encouraging businesses to adopt energy-efficient technologies and practices can also reduce energy consumption and lower costs. African governments can therefore play a role by offering incentives and subsidies to domestic businesses for adopting such technologies. This could help to accelerate Africa's growth and economic transformation, especially at a time when the world is gradually transitioning to a renewable energy system. The productivity of the African workforce is also a crucial determinant of business costs. High labor costs driven by a mismatch between skills and job market demands contribute to inefficiencies in many sectors. Governments, in partnerships with the private sector, must therefore invest in technical and vocational training programs that equip workers with the skills required by industry. This will not only reduce labor costs, but also improve productivity and competitiveness. We also need to introduce policies that encourage the movement of skilled labor across African borders, facilitated by the AFCFTA, so as to help fill critical skill gaps in various industries, thereby reducing recruitment costs and boosting innovation. Finally, technology offers a powerful tool for reducing costs across sectors. Digital solutions can improve business processes, they can automate operations and reduce the need for expensive human labor. It is therefore crucial that we enhance e-commerce platforms and leverage fintech for cost reduction with accompanied regional and/or continent-wide awareness campaigns in terms of their usage and benefits. E-commerce and digital marketplaces can lower the costs of accessing new markets, they can reduce overheads, and they can improve business efficiencies. Governments should therefore incentivize digital transformation in the private sector through tax breaks and subsidies. Similarly, fintech solutions such as mobile banking, digital payments, and blockchain can reduce transaction costs, enhance financial inclusion, and increase access to affordable financing options. Distinguished ladies and gentlemen, I'd like to conclude my remarks by emphasizing that reducing private sector costs in Africa is more than just a financial issue. It is a fundamental development imperative. It is not just about lowering expenses. It is about unlocking the potential of Africa's entrepreneurs, businesses, and industries. By addressing the distortions in credit rating assessment, by tackling the African risk premium, and by pushing for more nuanced debt sustainability assessments, we can create a more equitable financial ecosystem that empowers African businesses and governments. Furthermore, by improving infrastructure, by enhancing access to finance, reforming regulations, and harnessing the power of technology and regional integration, we can create an environment that empowers African businesses to thrive. We at Afreximbank are committed to working in close partnerships with the various African governments, international partners, and the private sector to unlock Africa's enormous economic potential, which is critical for its growth and socio-economic transformation. I thank you for listening.
Thank you so much, Dr. Kale, for bringing the knowledge of Afreximbank, not just in terms of overarchingly for the continent, but also from a very practical perspective of the issues that you deal with in trying to enhance development on the continent, including through the financial sector. So thank you very much. We're really pleased to have had your speech on behalf of Dr. Arama as well, who unfortunately couldn't make it, but we're really pleased that he was able to send you as a representative to share that wisdom with us. I'm going to pass now to my colleague, Mr. Trevor Luere, to join us for sharing the results and findings from a recent report that we did, specifically on one aspect of private sector engagement. The keynote speech, of course, explained a whole range of private sector engagement that we're talking about and will talk about today, but specifically around Eurobond finance from the international private sector. Trevor, over to you.
Good morning, and thank you for being with us today. My name is Trevor Luere, and I work as an economist at Development Reimagined. I have the pleasure of sharing with you some of the findings of our work, as Hannah has explained. Not to suggest that bondholders are enemies of Africa, but the famous Chinese philosopher Sun Tzu says that if you know yourself and know your enemy, then you can't be scared even in 100 battles. So in talking about debt, it's also important that we understand the nature of debt, how it operates, to then be able to devise effective strategies in how we can bring down the costs of private sector debt in Africa. So our attempt in this report is to try and shed more light on the nature and mechanics of Eurobonding in Africa, and then draw conclusions therefrom on how African states, African governments can more effectively manage the cost of debt that arises therefrom. As has been said ably by the keynote speaker and Hannah before me, this is just one element of private sector debt. There are several other parts of it: domestic borrowing, private bilateral debt, but we focus on in this report only on the euro bonds. And to give us sort of a flavor, the average costs of borrowing, we did just 3 kinds of private sector borrowing that we represent here. Private bilateral lending, about 4.5%, Eurobonds around over 8%, and then domestic borrowing around 5-6%. So we zoom in on Eurobonds, and that will be the basis of my brief presentation this morning. So the report undertook a study of the active Eurobonds held by different African countries to try and understand how much is there, what is the payment or amortization schedule going to look like, at what point do we anticipate that there will be fiscal strains in terms of repayment of this debt, and therefore, given that picture, what then must happen in terms of a more effective way of managing the costs of this debt. And what we find is that, number one, there's 19 African countries that currently have Eurobonds that hold a total of 91 bonds, whose face value comes to $111 billion. And I recently found out that that is about the capitalization of all multilateral financial institutions on the continent. To put that in perspective, $100 billion, $111 billion that African countries that are holding Eurobonds at the moment, the face value of that debt. But 65% of all of the face value of that debt is held by just 5 countries. That is Egypt, Nigeria, South Africa, Angola, and Ghana. So the usual suspects. 65% of the number of bonds that have been issued is held by just 5 countries, and they account for 71% of the total value of that debt. So when we talk about Eurobonds, it's very important to put in perspective, because it doesn't affect the entire continent uniformly. It's concentrated in particular places, and therefore the strategies that arise from our understanding of it must also be alive to that reality. The second key finding is that we try to do a Euro bond debt to GDP ratio. Now, we're all familiar with debt to GDP, so we try to do Eurobond debt to GDP to try and make sense of how much do Eurobonds account for in the debt profile of these different African countries that actually have active Eurobonds. And we find that the share of Eurobonds as part of total external debt varies significantly from less than 1%, so 0.87% for Ethiopia, to about 25% for Gabon. Again, different African countries, because of the size of their economies, have borrowed different sums or sizes of Eurobonds, and that influences what the share looks like in terms of their total external debt, but also as a share of their GDP. Countries that follow closely behind Gabon is Ghana at about 24%, Angola at 19%, and those have the highest relative shares of Eurobonds as part of their, as a share of their GDP. And then we also try to estimate, given the terms on which these Euro bonds were agreed, what or when is it likely that there's going to be fiscal strain in terms of repayment? When a country is likely to find some challenges, when a lot of either the coupon repayments or the principal repayments are going to be due, or both those things. And we find that the most strenuous time is going to come between 2024 and 2028. 2024, we've already seen what that has done this year. We expect a similar trend next year in terms of the fiscal challenges that are going to come from having to deal with Eurobonds in particular. That will be followed by 2027 and then eventually 2028. And then this has been ably talked about by our keynote speaker, Dr. Yemi, but the cost of issuing Eurobonds is heightened by the Africa risk premium. Depending on where you read from, it can range from anywhere of 3% to above 3%. We put that at about 2.9 percentage points higher than other regions that are issuing Eurobonds in international capital markets. So, to try and give you a flavor of what that looks like in terms of continental map, so we say 19 countries are holding Eurobonds. for a total face value of 111 billion, but 71% of that amount is concentrated in only 5 countries. So here we represent the absolute value of the Eurobond debt held by these countries and the share of debt, of Eurobond debt to GDP in those specific countries. So the countries that we highlight in red are countries where Eurobond debt accounts for more than 20% of GDP. Countries highlighted in yellow, these are countries where Eurobond debt ranges between 10 to 20% as a share of GDP. And then those in green are countries where Eurobond debt ranges between 1% to 9% of GDP. So the countries in red, you can see Gabon with an absolute value of $17.5 billion in Eurobond debt, which accounts for about 25% of their GDP. So Eurobond debt as a share of GDP. That is followed by Ghana. Ghana has, in absolute terms, $5 billion, which is about 24% of a share as a share of their GDP. You can see Egypt, 56 billion. That's accounting for about 12% Eurobond debt as a share of GDP. Angola with 20 billion in total Eurobond debt, which accounts for almost 20%. And then Cote d'Ivoire with about 12 billion, that accounts for about 17% of their as a share of their GDP. Okay, so we have 14 countries that have a range between 0% to 9% of GDP. You have 3 countries that owe between 10% to 19% of GDP, and then you have 2 countries that have over 20%. So we talked about our attempt to sort of predict when fiscal strain is going to emerge in terms of repayment, both coupons, but also principal payments, or both those. The figures may not be too clear, particularly in the countries that are in the red zone, but those that are in red, which is Nigeria and Egypt, 2 of the largest economies on the continent, we expect that they'll have more than 7 years of fiscal strain as a result of just paying back Eurobonds. This doesn't talk about all the other debt they're going to have to deal with, just Eurobonds. More than 7 years of fiscal strain. Countries in yellow are countries where they're going to have about 4 to 6 years. And this is between 2024 to 2048. Okay, so over the next about 25 years of repayments of these Eurobonds. And then countries in green will have anywhere between 1 to 3 years of fiscal strain. Now, like we said, our estimates, we are thinking 2024, as we've already seen, has been a difficult year for repayments. Countries like Kenya have had to refinance their Eurobond debt. We think 2025 was going to have similar dynamics. 2027 will follow shortly thereafter, 2028. However, we think that between 2038 and 2042, there might be a bit of relief. But that's far off in the future. We have urgent business to deal with at the moment in terms of strain. So countries that have between 1 to 3 years of fiscal strain, about 12 countries, which is a good sign. 5 countries have about 4 to 6 years of fiscal strain, and then 2 countries are going to face more than 7 years of fiscal strain. And that is important because the economic preponderance, the economic importance of these countries varies. Like we said, the 2 that are in the danger zone, Egypt and Nigeria, are important countries economically, not just in Africa, but regionally and the world as a whole. Okay, so we've seen the costs of Eurobonds. We're all aware of how high those are. How do they compare to other alternative bonds that are out there? We compare these to samurai bonds that are issued in Japan, and the panda bonds that recently happened. We had the first issuance of a panda bond by an African sovereign, Egypt, earlier. So samurai bonds go anywhere between 1 to 3%, 1 to 2.5%. So we put the average at about 1.5%. Whereas panda bonds, the one that Egypt issued recently, was at 3.5% over the course of its lifetime. So you can see that relatively samurai bonds are cheaper, and panda bonds as well are cheaper compared to Eurobonds, even if African sovereigns haven't as yet enthusiastically embraced these alternatives that exist out there for various reasons. Okay, so what are the implications of all this? Given that we know the cost, we know what or when the fiscal strain is going to come about, and which countries are facing what kind of trouble with respect to dealing with the Eurobonds, we have 5 recommendations that we want to put forth for African sovereigns. Number 1 is that being aware of when fiscal strain is going to emerge on the horizon should prompt some creative, innovative thinking about then how do we deal with the upcoming debt. And one of those options that emerge is debt buybacks. It gives an option to buy back debt more cheaply to avoid the exorbitant costs that are going to emerge when eventually that fiscal strain comes about. So, for example, we've said that the years 2024 to 2028 are going to be years of fiscal strain for African sovereigns to pay back Eurobonds. And so it's a window of opportunity to attempt to do debt buybacks that can help to scale back the cost of that debt, the overall cost of payments, if it can be bought at cheaper rates than how much is being paid for on the coupons of the bonds at present. Secondly, as we've seen from the comparison with other bonds that exist in the market, the Samurai bond and the Panda bonds, and has been emphasized very clearly by the keynote speaker, it's very important that we think creatively about alternative financing options. This being a market, having some buyers or sellers having more significant power than others means they can set prices and leave the rest of us as price takers. And so if we embrace alternative options, if African sovereigns embrace alternative financing options more enthusiastically, more boldly, even those that haven't traditionally been attempted, we can start to chip away at the power of the price setters and bring these things to a more realistic level of pricing in terms of interest rates. 3, which is also emphasized by Dr. Yemi, is improved debt management. And part of that is the kind of work that we've just shared here. It's not just a matter of borrowing and then managing while we've already borrowed, but doing this sort of analysis and anticipation and projections to know once we take this money, what will the profile look like for paying back? And that can empower debt managers in Africa, in ministries of finance, public management, to be more effective in how they manage the debt. So that sort of projections that are in advance of even taking the debt itself. So understanding the nature, the mechanics of the different types of private debtors that we deal with will also be very helpful in that regard. Then number 4, asking for longer maturity debts. We all know Egypt started us off in that regard. Usually Eurobonds were going for about 10 years. Egypt asked for a 20-year bond. I think Tunisia or Egypt now has a 40-year bond. African countries should definitely seek for longer maturity periods on their Eurobonds, as well as other private sector instruments. And then finally, coordination. The point has been made in various fora that creditors are very good and effective at coordinating amongst themselves. And we've started making progress on the African side to coordinate among ourselves. How do we then engage with the world, given what we know and what the terms are of us engaging with those that we engage on the other side of the table? So coordination then becomes important. If we have a common understanding of the profiles and mechanics of these different private creditors, then we can also put together an effective strategy to engage with them, to find ways amongst ourselves, both the creditors and debtors, on how to bring down the costs of borrowing. Thank you very much.
Thank you, Trevor, for that deep dive into the question of Eurobonds, in particular for African countries, and how African countries can not only just deal with the existing ones, but also think about future-facing strategies for raising more Eurobonds and other types of bonds going forward as a particular type of private sector finance available to African countries. We're going to move into the next section, which is going to be a panel discussion. And so I'm going to ask our panelists to join us here. We are also joined by one other panelist online. So please come up and I will introduce you as you do. So first up we have Dr. Hanan Morrissey, who is the Chief Economist and Deputy Secretary for UN Economic Commission for Africa. Extremely busy, so we're really pleased that you're able to join us today for this discussion. Please just sit anywhere. And next we also have Mr. Olivier Pognon, who is the CEO and Director of the African Legal Support Facility. Thank you very much, Olivier, for joining us. And the African Legal Support Facility, as you may know, do a great deal of work with African countries, both in terms of the negotiations with bilateral lenders, but also with private sector as well. So I'm going to sit down. We also have online Dr. Meshek Mutize, who is the lead principal expert on credit rating agencies for the African peer review mechanism. Thank you for joining us, Meshek, online. And sorry you can't be in here in person, but we're really pleased you're able to do so online anyway. I'm going to join the panel. Okay, let's check if this is working. Is this? Yes, it's working. Brilliant. Okay, so Dr. Morrissey, I'm going to come to you first. You know, this is the question of private sector engagement is complex, not only because when we're talking about the private sector, you can divide that into the domestic private sector, the international private sector, and on both of those, we also have, you know, we've talked about bonds, for example, or debt issuance. There's also equity and investment, foreign direct investment from the private sector. And then there's something in between, which is sort of project finance, which can be debt, but there's also public-private partnerships. And if you have project finance, that's often needs some kind of guarantee to deal with some risks. So for those of us who are not always in these discussions or kind of are not always super familiar with all these terms, it can be a bit confusing, definitely. But from a development point of view as well, I think Dr. Yemi was referring to this really well, that there's a kind of a tension. There's costs for the private sector in terms of private sector engaging and trying to do things on the African continent or anywhere else. But then the private sector itself can also impose costs. And we talked in Eurobonds as, 8%, etc. That is a cost of servicing. And so how do we deal with those sorts of tensions? Unlocking economic growth requires bringing, in a sense, both of those types of costs down. And again, just to give an idea of some of the costs that we might be talking about when it comes to the costs that private sector might, in a sense, require or impose. We've all seen types of projects which are things like a toll road, for instance, which might be through a public-private partnership, but sometimes those toll roads might be empty. Maybe a good thing, but also perhaps that also means that the cost for citizens is too high. Similarly, when it comes to energy, we talked about there was an example of the importance of energy and low cost of energy, but sometimes those costs are very high, but that's also because a company that's engaging in energy and working on the power project is trying to recoup a cost as quickly as possible. So they want a higher electricity price. So just to give you bring this to life, Dr. Morsi, what's your view on how do we bring both of those types of costs down? What are the strategies that African countries are taking to bring the costs for the private sector and of the private sector down?
Thank you. You can hear me? Thank you very much, Hannah. It's wonderful to be with you here today on this very important discussion. The part I'd like to focus on and emphasize is enabling private sector, because with the type of challenges that the continent has in terms of the demographics, the youth bulge, the huge development needs. It can only be achieved with the private sector being an engine of growth. So if we are not able to do that, we will not succeed in creating the level of job creation that is required or fully achieving our development goals. So when we're talking about that, then we need to understand why is it that we're not getting the private sector development and being, the driver of growth. And a very important part of it is the issue of the cost to the private sector. And here, when we talk about private sector, we're talking about basically investors, whether it's domestic or foreign. Okay, companies that are actually coming to the continent, investing in the continent, establishing, private companies and creating jobs. Okay, so when we talk about that, there are number of elements on what hinders it. Part of it has to do with the environment, the business environment. Okay, for the private sector, some of the cost is driven by: do you have a policy and regulatory framework that is stable? They know that what you're taxing today is going to be what you're taxing tomorrow, or whatever the regulatory framework that you have. They have, kind of predictability of it. So there is that component of it in terms of the environment, and this really is critical. I think even beyond that, I think we had these discussions in different domain when we're talking about, for example, how do we mobilize taxation? A lot of the time, a lot of governments, what they focus on is giving fiscal incentives, tax breaks. But before you even go that route, you need to understand what is it that the investor is looking for. Is that the most important? Most of the time, that's not. What they need is they need to have the predictability and certainty of the environment that they are operating in, the ability to operate without having to deal with energy cuts, that can, in some industries, may mean huge losses if you cannot, run refrigerators or assembly lines or whatever. So there are certain elements that will matter a lot more if you're able to ensure that continuity of energy supply. They will happily take that over the tax incentives because they will pay much more to handle these type of issues. So I think the conversation should start with a very constructive discussions with both the investor at a domestic as well as foreign and domestic investors to understand what is it, what are the issues that they're looking for, how do you help them? And there are actually some good examples of, for example, investor councils that are done within the continent. Among them, for example, is a council that was established a few years ago in Morocco when they started to change some of the incentives and regulations. So it was a way of feeding into that, having, the government, the private sector, domestic and foreign, and then getting feedback on these changes. What is working? What is not working? How can we adjust? So that's a critical part of ensuring that you have that dialogue and adjusting accordingly both regulations and measures. Then, issues of also, the ability to operate, like the energy issues. Another key problem that we have, and it affects the private sector, for the private sector to be able to target larger scale markets within Africa, especially in the context of what my colleague here have just been emphasizing, the African Continental Free Trade Agreement. You need to be able to actually transport these goods across continent. And cost of transport is, is the highest in the world. So unless you can actually tackle that cost to make it affordable for them, it deprives the private sector from expansion opportunities. So there are also, tariff and non-tariff. So all these issues, like it's not just the finance. We haven't even got there. But all these issues matter for the cost and operation of the private sector. Then you have the issue of the finance. And like anywhere in the world, the private sector gets, charged interest rate at a premium higher than what the government of where you're getting that, financing from is charged, because it's seen as riskier than lending to the government. So basically what it means is that the private sector will only get higher interest rate than its own government is getting. And when you have a problem with how high the interest rate is being charged for sovereigns across the continent, it means it becomes almost a huge obstacle for the private sector to even get finance. If the government is getting interest rate of above 8%, sometimes 11% and higher. And in some countries, without naming countries, the interest rates can go to above 20%. How do you expect, what type of activity do you expect the private sector to do and still be able to generate sufficient profits to be able to afford that financing? So that means that, first of all, you need to tackle the core issue in terms of reducing that cost for the sovereign, and we can talk about how. But at the same time, meanwhile, how do you bridge that? And you bridge that through instruments, giving guarantees, de-risking, blending, so that you reduce the cost of the finance available to the private sector. And that becomes really important for them to be able to access that finance. So that's for, investors within. Outside, we're talking about how do you reduce the cost for the governments. It's I think here there are number of issues. I really like the presentation earlier by Development Reimagined colleagues. One of the key things I think is the need to diversify the sources of funding. Okay, so it's good that we've seen, lower interest rate, by samurai bonds, by panda bonds, different from euro bonds. So the ability to diversify and tap different markets, this is an important element. But also, there are, a few things that we need to do, like, even at a local level, to deal with issues, for example, related to credit ratings. There is a part on the African side, which is, making sure that we have the data, reliable, credible, and regularly available data to reduce the, kind of the subjectivity of these ratings. Because if you have the data available, you don't need to make any, conjunction about, okay, what would it be or how to interpret what you know. So that is very important, to invest in it, to build the capacity, and to engage also in conversations and discussions around it and around, what are the assumptions, how it's being done. That dialogue is very important. At the same time, there are things that need to be done generally in terms of looking at the methodology, how often these, revisions are done, how many times, is that consistent with what is done elsewhere? Is there, kind of a bias when, a coup happens in Niger? How does it affect, the market sentiment, whether in terms of credit rating or even in terms of spreads? I've done research before on this issue of investor herding behavior. One of the things that I have found is that investors for Africa, and different from even regions like Latin America, they tend to think of Africa as like one investment asset class. So there is no differentiation among countries as you see that differentiation in other regions. And that requires a lot of investment in raising awareness and distinguishing so that when you have some sort of a conflict or a coup somewhere, you don't think that, oh, it's affecting my, what I'm holding for South Africa or for Angola or for Egypt, because that's actually in a completely different region. So these type of issues will need to put the time and effort to really invest in showing the differentiation. There are different groups, different circumstances, and what does it mean?
Thanks so much, Dr. Morsi, and thank you also for definitely reminding me of your work on the herding behavior. I think it's really important and interesting that we should be thinking about how to unlock that, as you say, including through more awareness. I want to come back to this question around bonds and foreign investment, but but maybe before I do, let me ask Olivier. Many people know the African Legal Support Facility for its work with governments with regards to other governments or bilateral lenders or even multilaterals. But you also do work with African governments and private sector negotiations and kind of working through some of those contracts. What's your assessment of how African governments are trying to bring down the cost of private sector engagement? Or what sorts of challenges do they face when engaging the private sector, and how do you help with that?
Thank you, Hannah. I think the considerations that African governments come across when dealing with private sector or challenges they face do not really differ from what you could be faced with in the, let me say, non-public sector world. It's and at the African Legal Support Facility, being mostly lawyers and believing in the strength and the binding nature of contracts, we tend to think that the dynamic of the relationship boils down to what has been captured in the contract. So with that assumption, I think what I believe is that the power of negotiation or the bargaining power wasn't always used by African countries to the full extent of what it should be, in a normal negotiation situation. And that's informed by what? It's informed by, I would say, lack of exposure. And that's where the African Legal Support Facility comes in to try and upskill African government officials, because basically there are two ways, to close a capacity gap. It's either by doing, so you learn by actually being on transaction, negotiating and being around the table, or the other way is to having been exposed by way of adequate training, so that when you face an actual situation, you know what how to behave to address the challenge. So I think there's this lack of exposure, which leads to certain contracts with the private sector not being fully informed, hence not properly documented. I'll give you one example. We met a country delegation yesterday, and we're trying to understand what they had in the pipeline, for which the African Legal Support Facility could support them, since we provide capacity building, but also assistance with complex litigation, resolution, etc. And so they said that they were in a tricky situation with an independent power producer and provider. They signed a long-term contract with very stringent clauses, and the obligation to, with an offtake obligation to, that actually triggers or increases automatically from, let's say, just random figure, 20% to 70% of the electricity that is produced. So they signed at the time where they were under constraints, and they needed that energy provided, by the external supplier. In the meantime, 2 years down the line, they supplied energy, additional energy from neighboring countries. So right now, they're faced with a situation where from January, they have to get into an uptake of 70% of the electricity produced, while they can only absorb 25% because they've managed to plug, the gap that they had at the time. So they find themselves in a situation where they would have to get into a very painful renegotiation of this agreement, almost impossible, and that will cost them. It will inevitably cost them, and it will also sort of destroy the trust relationship with that provider. So so that's a situation where lack of proper planning and lack of a contract being documented in a way that if you have that kind of changes in the economics of the contract, you have something to fall back on, or you have a mechanism that is pre-discussed and pre-agreed, so that you don't just fall into a situation where you have to get into a litigious type of relationship with your service provider. So failing that, thinking ahead of getting into the contract, you get into a situation that obviously costs you not only money but also cost you reputation and increase your risk premium because of the perception created.
Yeah, so the kinds of work that you do with the governments are effectively trying to ensure that they don't get into those sorts of contracts in a sense, but also to manage those more carefully. And just to be really clear, the point of this example, for example, is that that government is obligated to pay that producer for that power, even if they're not going to use it at all. And actually that's something that happens quite a lot in many African countries, despite also having power shortages. This is why these issues are so complex. But so I guess that capacity building, and I would expect perhaps experience sharing across countries as well, can be quite helpful to that, in terms of avoiding these kinds of contracts or costs. So let's come back to that too, and what that means and what that entails. But let me come to Mishek as well, because you work on credit rating agencies issues. You're helping to create the African Credit Rating Agency. Dr. Yemi pointed out in his keynote speech that there are some fundamental issues fundamental issues around credit ratings and also debt sustainability assessment, which do affect the overall cost and perhaps even the willingness and perception of private sector entities like power producers to take certain risks, and therefore they want to go and ask for really high outcome contracts, which really make sure that they don't face any risks or face the lowest risks as possible, even if that's not realistic. So you also saw the analysis on the Eurobonds. What's your view on how African countries can get lower interest rates with bonds, for example? Is it just about engaging with the credit rating agencies? Is it just creating a new credit rating agency, or are there other things that you also suggest from your experience, Dr. Mutize? Over to you.
Well, thanks so much, Hannah, for inviting me. It's a very important conversation. So I hope I'm audible. And apologies for failure to join you in the room. I would have loved to the ABC. So on the question of perception of risk, I think the conversation has been laid on a very small footing. but I would want to take two perspectives on that challenge that we face in Africa. Over the few years that I've been working in this subject of debt sustainability and credit ratings, of course, there is one dimension where you can point out the challenges that rating agencies themselves have presented to the debt sustainability issues in Africa, one of which is the pessimist approach to the assessment of risk and how they misinterpret some of the activities that happen in Africa. Just to, for example, to point out a few areas that we have engaged the rating agencies with, they have admitted to potential improvement in the analysis in future, like how they interpreted the intention to buy back the Eurobond in Kenya, and how the analysts made commentaries that disrupted the market, causing spikes, which was very unnecessary to do that. I think also in several countries, like we saw Cameroon recently, where the rating agencies actually downgraded the outlook of Cameroon because of the intention to increase civil servants' salaries, despite all the other fundamentals and fiscal metrics pointing in the positive side. So such a misinterpretation of risk, or failure to understand the domestic context of African government has really fed into high risk perceptions in Africa. And of course, one point that we always make is that these analysts need to be in Africa to make such pronouncements. You can't be making such pronouncements accurately from UK or the US. But coming back on the other dimension, I believe that there are several factors and variables that are within the control of our member states and governments, which, in my view, have really propagated the negative perception of risk, which rating agencies themselves also pick up on, as well as investors with intention to put money in these countries. Like, for instance, I think Afreximbank has been raising this point. The issue that official forex reserves or central bank savings, the whole, in fact, we can describe it as Africa's collective foreign reserves, which are estimated around 300 billion, or 10% of the GDP of the whole continent. And adding to what Dr. Hemi has pointed out, the remittances that comes from the diaspora, combined, this can be a very significant pool of resources that can be utilized on the continent without taking such resources outside, because these resources are invested in the so-called richest countries or stable economies in the US, Germany, Japan, or the UK. And what you find out is ultimately this money will still come back to Africa, but at a higher cost. And who is paying that higher cost? It's still the governments or entities that are borrowing. So if these reserves are invested in better rated entities, like you have the Afreximbank and AFDB and other African development banks that have got preferred creditor status on the continent, there is no reason why these investments cannot be classified as low risk, meet the criteria of a safe investment haven or a liquid investment that can be accessed within a short time. So that's number one. And number two, you find that there is a lot to be done on the government side in terms of engaging investors, in terms of managing investor relations. There's been a very good example when there were challenges in Ghana towards the episodes that led to it being closed out of the Eurobond financial market. They had some very good engagements through road shows and visiting investor hotspot and engaging them on the areas of concerns that were being propagated by the public media. And you find that also a number of our governments don't have this kind of interface or appetite to issue official communications just to present the position of government. So you find that the arena of speculation becomes very rife because there is no that engagement with the relevant stakeholders, investors, and rating agencies in this case. So adding to what Dr. Mosi has pointed out, the issue of data has really been at the center of this point, that governments don't have this data. You go to the website, there is no data about the Eurobonds that they have borrowed and where this money is being utilized, what is the fiscal metrics around this very important area of interest that investors are looking to track. Even though you find that there could be speculations in the public platforms. Like, for instance, I think there was an issue in Ethiopia and Kenya, speculations around the Eurobond proceeds not being accounted for. So when you have such prejudicial information on the public spaces, it is important for the government to come to the official channels and communicate with investors on the official position of what the government is doing in terms of utilizing such resources. So that's a very basic process that is very important in terms of bringing the necessary transparency and accuracy in management of public information. I also raised the point that Dr. Yemi has reiterated in his keynote, the issue of strengthening domestic markets. So it's not just in words that we talk about developing our domestic financial markets every day in, day out. But there are simple steps that our governments should take. Because, you know, in our African context, governments are very important players in financial markets. There is a lot to be desired if in a domestic market you find that government is not taking part at all in terms of having its instruments traded on the domestic market. And what it then does, immediately, there is no investor who feels safe bringing money to a domestic market where the government in that jurisdiction has no confidence in. So you find that several of our governments also don't have, or they try to keep their instruments outside the realm of regulation or inspection or oversight of the domestic regulatory frameworks, because they are not interested to go through the minimum requirements of getting approvals at a domestic level. So this creates this black box that investors become more skeptical to put in money. And if they do, that's where the high premium comes in. So it's important for governments, if they are concerned about the issue of liquidity and capitalization market depth, which is quite common. There is the issue of cross-listing that we have seen happening in a few of our countries. I think Nigeria has done that recently to cross-list some of its instruments just to feed into the liquidity and confidence of the domestic market. And lastly, I will align my inputs to the question that you have raised, Hannah, on Eurobonds. You know, I've always raised the point that there is no need for Africa to celebrate the oversubscription of Eurobonds as a success. It's actually an embarrassment, and it should be a point of disappointment. Because if all of our bonds that we have issued since the advent of the Eurobond market has been oversubscribed by an average of 4 times, why can't we leverage on this oversubscription, the oversubscribed book, to negotiate for better term or better tenure and better interest rates or yield? Because it shows that the markets have appetite to buy into our bond. So if our bond is oversubscribed by 6%, there is no reason why we should take up the same interest rate. But we should use that opportunity to negotiate for a better interest rate. So this, I know from the side of the bond issuance syndicates, it is good for them because they want to close the transactions and make a killing and come out of the transaction without any obligation of underwriting something that is not sold. But from the government side, it's actually a liability because immediately after issuing the bond, the next headache is where the money is going to come from to pay the coupon in a very short tenured bond. We know the challenges behind why Eurobonds have been quite attractive because they are more of an open check, and IPOs are not obligated to disclose the specific use of proceeds. But it's important to bring that sense of accountability and responsibility to the process and make sure that these proceeds are being used for the purpose that they've been utilized for. Talking less about other options of borrowing that colleagues from Development Reimagined have pointed out. Sukuk bonds, I think Egypt has raised funds through such bonds, the Panda bonds and Samurai. It's a very important option to consider rather than just concentrating on Eurobonds that we know very well that have become very unsustainable to raise private capital for. So let me pause here. Thank you.
Thanks so much. Thanks so much, Dr. Mutize. And I think in particular, your first point in terms of raising awareness also of diaspora bonds, which are in themselves also a means of diversifying different types of financial markets to be able to raise finance from, but also your last point in terms of, you know, how do governments actually make the most out of these markets, and are they doing enough to do that? I'm going to come to Q&A, so please do, for our audience online and in person, please do get your questions ready for our panelists. And I'm hoping also Dr. Yemi might be able to join us to answer any questions if there are any that come to Afreximbank specifically. But before I do, let me just take what the chair's prerogative, moderator's prerogative, to ask one more question around, and this is to all of our panelists. You know, we do see a lot more activity by African governments to work together on these questions and kind of coordination. To what degree do you think that they're addressing these sorts of issues at this point together, exchanging experience together? And if you don't see that, what do you think needs to be done in order for that to happen? Dr. Morsi, you're involved in so much of working with African governments together. Yes.
Thank you, Hannah. We see progress, but not enough coordination, particularly in regard to the private sector aspect. I think, you know, one of the things that a great opportunity that we have is to have this harmonization of the investment regulatory frameworks across the continent, you know, to support the Africa Free Continental Trade Agreement. And that would open, you know, huge opportunities for the private sector. Part of the attraction, for example, for an investor when they go to European Union is once you established in one, you know what it takes. You can expand anywhere else, and you understand what would be required. Similar, in the continent, if we're able to have that harmonization of, the investment regulatory framework, that would open these opportunities. What we have seen progress in, for example, is looking into issues of like cross-border payment systems to enable private sector, particularly in the context of FX shortages and so on, to look into what could be done so that when we have two African countries, private sector trying to actually export to, but their goods are stuck at the port because there is FX shortages. And then the one that gets the brunt of this is the private sector, who have to provide for additional costs of maintaining their goods at the port. While we don't need that. If we're trading within Africa, if they can get paid in local currency, that at least will reduce some of that pressure on them so that they don't need to run the risk of going bankrupt or bear huge amounts of costs because of FX shortages of where to the country that they're exporting to. So we've seen progress in that area, some progress. We're not there yet, but we have seen it. I think we need to do more, a lot more efforts in developing the regional value chains, particularly for industries of the future, like green industries, battery production, around, industries around green minerals, because this is the future. And one of the things that, to me, I find interesting is that, and I had actually discussions over the last 2 weeks on this with some colleagues, is that we have everyone interested in it from all over the world, but we don't have our own investors investing in that area.
In strategic minerals.
Exactly. And in the value additions of the strategic minerals. So these are the type of discussions that we need to have more on across countries to understand what is it, what does it take, why there is no interest. Is it because they don't believe that there will be continuity, or that you don't have the skills? How can we unlock that by having that level of conversation with the private sector to understand what are the issues, and then to have conscious efforts of addressing and unlocking these impediments.
Okay, so it sounds like, Dr. Morrissey, you're saying there's some progress in terms of working together on these sorts of issues. You've given some examples. I think even the AFCFTA, there's an investment protocol and so on, right? So there is some progress, but definitely much more needed, and including in some very strategic areas. If we're thinking about forecasting and kind of thinking strategically going forward, some of these areas need a lot more kind of active sort of intervention and more focus. Olivier, would you agree with that too?
Yes, I do agree with Dr. Hannan that we see I would say limited coordination. When it comes to, say, negotiations of complex commercial contracts, but that's because each country has its own dynamic and follows its own dynamic when it comes to, if you talk about, loan documentation, for instance, each country would have its own dynamic in terms of negotiating either the maturity, the loan, the interest, whether they accept or not that the loans be asset-backed. So each country would have its own way of, and that's probably informed also by the regulatory framework in that, not necessarily out of the blue. So there's that aspect of each country caring about their own interest. But at the same time, we also see common initiatives, regional projects. At the LSF, we try as much as possible when we scale up training programs to hold them at regional level. So we did, for instance, a training where we brought all the PPP units across the continent together. It must have been 3 weeks ago in Nairobi. We had 30 PPP units under the same room, trying to exchange best practices and understand the common dynamics that inform successful PPPs. We're doing one next week again in Nairobi with attorney generals, trying to. So we try as much as possible from where we sit to share. First, to share our experience and our understanding of the Pan-African landscape that we see, but also to get stakeholders that have common interests to exchange and discuss and see what they can learn from each other. There are regional projects. There's the Africa Mineral Vision that there's Desert to Power. That's a large scale power projects driven by the African Development Bank. So there are some initiatives, not enough, but I think we're way more dynamic in that sense, and there's an awareness that's been raised clearly since the past few years. There's one initiative that is brewing, and actually Afreximbank will be or would be involved in that. We're meeting with your colleagues in Cairo at the end of November to see if there's a way to foster negotiation teams, national negotiation teams. The same way the WTO, negotiations happen with very, trained, skilled, experienced teams, Western mostly. We don't necessarily have that on the continent. So that's one idea that between different stakeholders we're trying to promote, that will also be an opportunity to train negotiators and get those negotiators to talk to each other and learn from each other. So that's also a lever that can be explored, and we're going to dig into that subject and see where we land with Afrexim and others.
Brilliant. Sounds good. And always good to know about new initiatives coming up, but also the fact that, as you say, it sounds like it, I see it definitely, that there has been increasing coordination and collaboration across governments, but definitely much more needed to go down, but also driven by African institutions, which is also fantastic to see. Talking of African institutions, Meshek, is your view as well that that there is progress, but there's more needed, or do you see that as a key gap in terms of coordination?
Yeah, of course. I think the three speakers have really spoken in my mind. Of course, there's still more that needs to be done in terms of coordination. The issue that was raised earlier about why we need even debtors to coordinate and collaborate in presenting the challenges that they face. But let me add my voice on the importance of private sector in this whole conversation. And I think a private sector has not been given the important value that it deserves before, in terms of generating the basis for building the blocks on the domestic capital market, which I think now there's been good progress. I'm saying that from an informed point of view on the discussions that are brought in the African Union policy platforms, which was also part of the basis why the ministers of finance adopted a position that we need a private sector driven African credit rating agency, which would be outside the African Union, to elaborate the fact that it's not that we are having a political reaction to the challenges that Africa is facing, but rather it's a legitimate need to revitalize the importance of the private sector. And if you look at it, most of the trading that happens, be it in the Western world or elsewhere, most of it is driven by the private sector because they do utilize these leverages on a daily basis. And I think they need it more than a government might need it at some point in time.
Thank you so much. So, audience, do you have any questions for our panelists? Yes, excellent. Yeah, there's a mic over there. Please do.
Yes, I'm struck by the fact that was shared by Trevor, I guess, that African borrowers go for the more expensive Euro bonds. Can you explain that? Why?
Dr. Matize, would you like to explain why African borrowers go to more expensive Eurobonds?
Well, I think we have interrogated the reason why African borrowers are, perceive that Eurobonds is a better option. So from what we have observed, it's because mainly, it's a combination of factors that they need an easy way or an easy process to borrow. So number one, concessionary borrowing has not been very attractive anymore because of the conditionalities that are attached to it. Government needs to implement certain structural reforms, or maybe before they actually receive the actual resources that they need. And those structural reforms are not very attractive to the political leaders because they are austerity in nature in most cases. That's number one. And number two is that, so compared to that, you find that Eurobonds are quite easy way to raise money. They can structure a bond, engage bond syndicates and sell the bond and raise the money in a very short space of time without any conditionalities. And number two is the issue of fungibility of the proceeds of the bond. We have examined most of the prospectus that accompany the Eurobond issuances. You find that in fewer cases, there is explicit indication of why or what these proceeds will be utilized for. But in many of the cases, it's just a general statement or a general description that this money will be used for supporting the fiscal budget without specifics of where this money will be utilized. And that has been one of the gray areas that has led to abuse of proceeds from Eurobonds or being used for recurring expenditures, although this money comes at a very significant cost. Those have been two main reasons, but I'll also point out that, they, to some extent, some of interested on the constraints that come with Eurobond, especially to do with the tenure. Because if you look at it from a logical point of view, it is not in the best interest of a government to raise a very short-term bond, like a 3-year bond, at a cost of 6.5%, when they know very well that there would not be an alternative source of funding to raise the money to both pay off this bond and also to continue meeting the fiscal need that government has. So I think those have been the point of attractions why Eurobonds have been an easy source of funding for governments, or a good option for them.
Yeah, thank you. Very good question. And again, it's a balance, isn't it, in terms of the complexity of it, the demands of it, but also then, yes, there's always cost, but there's always some rationality behind it. It's just, in the end, sometimes it doesn't work out as well. It's also worth mentioning, I think, that the availability of samurai and panda bonds and other types of bonds has not been as strong. So that diversification is also slowly happening, from what I understand too. Any other questions? Yes?
Thank you. My question is to all the panelists. I wonder what sorts of institutional innovations you've thought of in engaging with the question we're grappling with today that can help to bring the costs for the private sector down. I think Hannah made that distinction in the start. Cost of the private sector, so borrowing externally versus cost for the private sector. What I have in mind is, for example, local government financing vehicles in China. The sorts, and Dr. Mosi made the case, as well as Dr. Yemi, we must put in place an enabling environment for the private sector to thrive. That needs money that is not coming cheaply or fast enough or in the right quantities. And so maybe some institutional investment or innovation is going to be necessary to find ways of drawing in, attracting this money. So I'm curious if there are any institutional innovations you've thought of within the context of the African continent. What assets, capital, value do we have locked up that can be unlocked or unleashed in a particular way? And one thing I have in mind that I'm curious to hear your thoughts on is modern monetary theory, for example. Would it have modern monetary theory? Would it have any place within the context of Africa and trying to generate the resources that are necessary to cut costs, production costs for the private sector on the continent? Thank you.
Great, thank you. Great question. And I'm going to ask the panelists if you could use that also as an opportunity to give us your sort of final thoughts on kind of the way forward as well. I think that would be helpful, and then we'll go to our closing remarks from Mr. Dizolele. So Meshek, I'm going to come to you first, then Olivier, and then I'm going to give Hanan the last word.
Well, thanks, Hannah. But Trevor, you are part of the team. You shouldn't be asking questions. But I think response to that is that, of course, I think there is an important leverage to explore modern economic strategies to raise funds. I think it's one of the points that we've been raising in challenging this orthodox approach that this is the right approach for Africa to manage their economies. We have contested that it's not a universally accurate approach that good ratings or successful economies in Africa has to adopt the traditional austerity posture, which I think personally it has been one of the challenges that countries that is defaulted in Eurobonds or whichever bonds they've defaulted is faced, because you find that they've a very good episode of growth, and after certain dynamics, which I think has been steered by this traditional approach of how the economics of a country should be run, there's steered a certain narrative and a certain conversation. Then the expansionary posture that these countries had taken, end up landing them in a very difficult position to be able to address the exposures that they would have faced. So let me pause there, and thank you very much, Hannah, for allowing me to take part in this conversation. Very insightful discussions.
Thank you very much for your contributions and great points there in terms of future interactions as well, in terms of economic independence, in a sense. Olivier, to you.
So I would struggle. I'm not an economist, so I would struggle to figure out what could be the specific steps to take to reduce cost for private sector. But as lawyers, I do believe that there's always been this discussions about the business environment and making the business environment friendly for investors. But the flip side of that is what is it that the government that receives investment can do not to increase cost for itself because of the perception gap the risk perception gap we were discussing, but also create an environment that makes the investor feel comfortable investing in the given country. So again, it takes things such as ensuring that in dealing with an investor, the investor feels that in case things turn sour, there's a dispute resolution mechanism that is proper, that is properly documented, and that he won't struggle to recover his assets or his money. There's ensuring that our arbitration centers are strengthened so that even if we as Africans want to see a litigation resolved on the continent, there's clarity at the investor's end that this arbitration center in Kigali, Douala, or Nairobi is equipped with whatever it takes for them to get a fair resolution process. And there's also the clarity in the legal and regulatory framework. So there's honestly, I believe there's work being done. I see every day efforts being done by African countries around these different areas. It may not reduce the costs of investing for private sector, but at least at the end of the day, these factors will actually help reduce the overall cost of the project, so that the investor gets his return on investment and the country benefits, derives the benefit expected from the project.
Thank you. A very hopeful view. Thanks. Dr. Morrissey, you get the last word.
Thank you. I think we've already talked about issues of enabling environment to reduce the cost, ensure that the private sector has, reasonable and reliable, supply of energy, reasonable cost of transport if they want to trade or export within Africa. And in terms of the finance side, we need to deploy more of the de-risking and blending instruments, use more of the guarantees, and we need to tackle the core source of the issue at a sovereign level. A couple of the things I think that Trevor comment earlier just brought to my mind. One is on the issue that we're not using within Africa much of raising bonds for projects. While this is, done in other regions. So it's one of the things that we need to look at, because if you have a very well-designed, well-structured project, and you're raising fund targeted for that project, it really can be a much better in terms of also spreads than otherwise. I mean, there is the example of Argentina that even when they had serious debt issues, they were able to raise funds for green projects that the cost of which was actually lower than sovereign. So it's an interesting example to look into, but also to think about this issue of financing for a very well-defined, structured project. And the other issue, and we've not touched on it, is the issue that sometimes you actually have very well-designed, bankable projects, and you've done all the legwork, and then you go to investors, but it's not the right ticket size. Okay, and for me, this is it's something that is very. I find it like you've done all the legwork, you've invested to structure a product, you're invested to make sure that it's bankable, and after all that, you come to the finish line, but they tell you, oh, we don't, finance less than $20 million US. This is a small one. So I think we need to invest more in having aggregators of bankable projects so that it actually provides the opportunity for those investors that are interested, that we get no excuses. So it's also another thing that I believe going forward we need to consider. And finally, on the issue of learning from each other and engaging, I think African countries have done, much better and well in terms of at policymakers levels. But I think what has been like I've been sensing absent is the interaction with the private sector, okay, within countries, but also across the continent. And I think this is an area that a lot more can be done in, that would be very beneficial because it's part of that dialogue that we're talking about. Why is it that we are, countries are exporting fertilizers to Latin America than to other African countries? I mean, these are the type, can we understand what are the impediments? Why is it that it's much closer and it's also needed? So understanding this and having more of these conversations would be very useful.
Great, thank you, Dr. Morsi. And again, let's also just be really pleased that we also have African banks represented here who are also some of these aggregators and also can create some of these opportunities for right ticket size and all that sort of thing, diversification on the African continent. So we're pleased to have had African Bank also take part. With that, thank you so much to the panelists. Thank you so much to our keynote speakers. I'm going to pass to my dear colleague from CSIS, Dr. Dizilelo, to close us off for this session. Thank you.
Thank you very much, Hannah. Not a doctor yet, but in the works. It's a pleasure to have all of you here today. Those are in the room and those are joining us remotely. The topics that we discussed today are very important. We've been having these conversations for a long time. However, I think the big onus, as much as Dr. Yemi Kale talked a lot about the role of the rating agencies and so on, the narratives on Africa remain the biggest obstacle I will submit to you on the development of Africa, just the way, if Africa is going to be in this global village, where it's going to play a major role for the future of the world and the sustainability of our lives. If that narrative or those narratives are still dominated from the north, there is obviously a problem because those narratives often miss all the nuances in between that make a difference. Having said that, of course, I'm happy that African Bank is here. I'm happy that Trade and Development Bank Group is also in Washington. So there are many organizations that can play a role. The question I've always struggled with is the gap between the private sector in Africa and the government in Africa. So you go everywhere, you hear a lot about investment, organization, chambers of commerce, and all that stuff. Yet the gap between what they're advocating and what the governments are doing, it's so huge. So in many ways, I'm not sure if that gap continues to grow, Fitch or anybody else will make a difference, because that push is not coming from the ground. But also the physical space that this development is supposed to take place. We get excited about the African Continental Free Trade Area. I just returned from a trip to 5 countries, Kenya, Ethiopia, Uganda, DRC, and Rwanda. And all those 5 countries cannot be more different than they already are. So that physical space itself is not, it's very important how the investor feels just the moment they land at the airport. And everything else risks staying just theory. So just something I wanted us to reflect upon. To our colleagues who join us today, Dr. Hanan Morsi, Dr. Yemi Kale, Mr. Trevor Luere, Ms. Hannah Ryder, Dr. Mishek Mutize, Mr. Olivier Pognon. These are something I think we need to think of. But I also want to thank you for joining us today and thank Development Reimagined for the partnership. Thank you. This concludes our session.